I've made over $350,000 in the last week of trading using this strategy. And this strategy and concept that I'm going to share with you today has helped me achieve these results and helped me change my trading forever. When I was starting trading, I was always wondering how are traders able to catch those huge breakout momentum moves. And with this strategy, I'm going to show you how exactly I'm doing that. And to top it up, I will also share 3 trades that I took last week with this exact same trading strategy. Let's dig into it, guys. In today's video, we're going to learn where to look for those big breakout moves. Try to eliminate the guesswork, guys, because one of the most common mistakes that traders are making is trying to guess where the price is going to go next. Whereas we as traders should look in trading as a business. Trying to eliminate bias should be one of our #1 priorities. And those 3 trades were taken in the last week of trading using the same exact trading approach. In today's video, we're going to follow this 3 simple step approach. We are first going to start with the higher time frame context. Then we're gonna go to the lower time frames and where are we looking for those entries so we can actually avoid the common traps that usually the retail traders are making. And then to top it up, I would finish the video with 3 trading examples which we took last week. So all of those trades, if you follow the methodology and the framework in the same way, can lead to very high returns. And you literally need 1 or 2 of those trades to capitalize on and to be able to finish your month in the positive territory. Of course, this needs to be followed and the same strategy needs to be applied for this to become reality. The results are there, the proof is there, so there is nothing to really stop you from achieving that. Have you ever entered a textbook example like that? You're waiting for the price to break below this major level or support zone. Then you're waiting for the price to retest this from the bottom, and then somewhere around this level, you're looking to enter in short trade. Unfortunately, minutes later, you do realize that the trade that you have entered here, you're expecting this to turn into a short trade, is wiping out your stop loss, which most likely was placed somewhere around here. And the price not only wipes up your stop loss, but completely changes direction. So this is one of the most common mistakes that traders are making. And this, unfortunately, are traders that are betting on a breakouts and trying to predict market direction. This is one of the first cues that you should make when trading, and try not to predict where the markets will go because this is simply futile. And here is what you should be doing instead, guys. So the previous screenshot was showing you how and why traders are waiting in anticipation and trying to predict market direction. You should instead try to take the reactionary role. So instead of trying to predict where the markets will go and what is the next market direction, so instead of basically waiting for the price to make a breakout and look for a better place to position yourself and ultimately lose money, what you should be doing instead is to have a system that allows you to position yourself very early inside of a breakout. And what happens and what this system is basically when the price reaches the lower supply zone, in this case, is to take the exact opposite position of what majority of breakout traders would try to do. In other words, when the price goes inside of the supply zone or even goes outside of the supply zone, so we are picking out the latest standing stop loss orders, this is the moment where you should be actually looking to position yourself right here, just under the lower part of this supply zone. And this would potentially bring you to the next step that I wanted to discuss, or the breakout trade. Doing this in the contrarian way and being one of the first in the queue of the next imminent breakout without trying to predict it does 2 very important roles. First, on the line, as I said, so you're not risking being too late into the trade. And second of all, if this really turns out to be a breakout, but a bullish breakout, you would have entered this trade very early, being able to rake multiple R's in return. Here is a very clear distinction I wanted to make, and something that a lot of traders are missing, and they're watching YouTube videos like this video that you're gonna watch today, guys, and it's quite paradoxical. It's hard to know what works and what doesn't work. But what the most commonly accepted approach is to basically start from the daily, 4 hourly, then 60-minute or 1 hourly chart, and then only then go to smaller time frames and then start looking for daily direction. In other words, you're looking for direction from the higher time frame. So if you have an uptrend, then you would potentially be looking for long trades only, hoping for a retracement to a major level, and then going to the lower time frames like the 15 or 60-minute time frame, and then look for long only trades based on those time frames. And what I'm looking for is, first of all, the approach is quite contrarian. So we don't look at, for especially day trading wise, we don't look at it from this perspective, guys. What we're looking for is, first of all, an important recognition here is to make that we are not looking at the 4-hour daily or weekly prior to entering in a trade. I'm also not looking at the 60-minute prior to entering in a trade. So from this perspective, your role would be quite simplified and you won't be needing to look at those time frames at this point. What we're doing instead is we're looking at the 1 minute and 15-minute time frame. And to be even more precise, we're starting from the 15-minute time frame and only then looking at the 1 minute time frame. And we do this in this order with a specific purpose on mind. Okay, so how is this going to look in real time, guys? So let's see at a concrete example. We have the 15-minute demand zone and the 15-minute supply zone. I've pre-marked those for simplicity's sake. So what happens and what we're looking for is, once we have determined where those zones are based on the 15-minute time frame, and this is a very, very important clarification we need to make here, then we're moving down to the 1 minute chart and we're looking for the price to enter in this zone. So if, let's say, this is the market open, we trade both the NY Open and the London Open. What we're looking for is for the price to basically enter in, if we are looking for a long trade, but we don't really put ourselves in a position, I want to take a long trade, I want to take a short trade based on the higher time frames. So you're starting the day with a clear state of mind. So you don't have any predisposition, any bias. We're waiting for the price to enter in one of the opens. So let's say this is the London Open, 8 a.m. GMT time. And when the price goes close to demand zone, we are basically looking for the price to ideally fall below the center line of this demand zone, and even better, go outside of this zone. This will give us, based on our trading system, a very good possibility for a long, not short, long entry. Then once we are in a long entry, our stop losses are usually very tight because we are able to enter based on the 1 minute time frame and then do this with a very, very clear setup. And once you're in this trade, you're basically going against all of those guys that were trying to short sell here. So first of all, you're getting all their money. Then second of all, you're playing with all of the guys here that were going to open up a contrarian trade and go long. So you're winning twice. And this gives you the chance to potentially not just, play the breakouts, which could be a 1-2 or 1-3 risk to reward ratio trade, but you have a stronger ability to hold on to this trade and potentially get to the next zone or even further. So in this case, you may make a lot more than just 2x's or 3x's or 1-2 or 1-3 risk to reward ratio, as the examples I'm going to show you in the next part of this video. But you need to realize the mechanism here is not to go and wait for the price to come back to the support level or the demand zone, depending on which what are you using in your trading, but then for you to wait for the price to actually make a new low, and then from there to enter in a long trade. And of course, the same is valid if the price goes into your supply zone. Then again, what we'll be waiting for is the price to basically pass above the center line of this zone and ideally go outside of the zone. And this is where some of the best trading opportunities are. So instead of waiting for the price to retrace back to the level or this zone and then enter in a long trade, what we're doing is we're actually going counter the trend, and at this point we are opening a short position based on the 1 minute time frame, so we can actually minimize our stop losses. And then one of the most common ways and approaches that traders are using is targeting the next demand zone, which could be between 5 or 10 axis away from your entry. Sometimes we are actually making a lot more, but based on our system, which is quite complicated, and in terms of taking profits, this could be, you know, another video, but we're using time as opposed to the next major demand zone. And this concept, which I came up with, is known as timestamps or trading with timestamps. We're using time to help us to maximize the returns. But this again is going to overcomplicate the purpose of this video. This video's main goal is to show you where we are looking to enter in a trade and how we are trying to basically come up with a trading edge to maximize our returns based on the entry. And before jumping to my trades, guys, I wanted to share with you a student trade, which I think is even more relevant. This trade was taken this morning. This is precisely what I was showing you in the previous screenshot. So as you can see, this is where the trader, I've just zoomed out the trade itself. This was from our day trading room on Discord, but I've zoomed out the trade itself, so you can see this trade was basically risking around 50 something USD. Currently, it's making this trade around 450. So this is around 1 to 9 or slightly less risk to reward ratio. This, in no other circumstances, would have been possible with a breakout trade. Potentially, you might be able to get very rarely if the breakout is very strong, but how many times would you get a very strong breakout? This would be close to zero. Based on, to take 100 trades, maybe you can get 2, 3, or if you're lucky, 5 breakout trades. With our system and this way of trading, you are getting a lot more. So we're getting between 5 and 10 double-digit returning trades per month, which is trades like this one, sometimes a lot higher returns. So a few of the trades that I'm going to walk you through in the next part of this video, you would see that we were able to get into very high returns following the same approach of trading. Last week's trade, and this is the Nasdaq, and as you can see here, I took this trade during the London Open, so we risked only 6 points. And again, in order to get extraordinary returns, you need to do things that the majority of people will not consider doing. So what most people here would be doing is trying to potentially short based on a retracement. What we did is the opposite thing. So based on our rules, we managed to get into a long trade with very tight stop loss, and we managed to get out of this trade at 28 axis or 1 to 28 risk to reward ratio. So if we only targeted the upper zone, this would have given us around, I would say, 10 to 12 axis. We managed to get at almost triple that based on our timestamp rules for maximizing the returns. But even if you don't take into consideration, even 10 axis is a very large return when you compare this to a potential 1 to 2 or 1 to 3 risk to reward ratio that any other breakout trader is aiming for. And again, guys, this is not a coincidence. I wanted to show you the second trade of the week, which was a DAX trade taken again during the London Open, and this trade gave us 1 to 11 risk to reward ratio. I took profits slightly prematurely, but still this was a 11x trade, no matter how you want to look at it. And again, you can see based on our zones, this is exactly where I entered. As I mentioned in the first part of this video, we're looking for anything below the center line of this trade, as long as we are ticking all the boxes. This trade ticked all the boxes, and we entered in a trade, and this was literally not even 1.5 hours later, we managed to bank 11 axis on this exact trade. Let's have a look at the last trade of last week, and again, this was another double-digit returning trade. And this was the last trade of last week, which was a double-digit returning trade, guys, and this gave us 1 to 11 risk to reward ratio. Again, quite contrary to what most people would have been looking for to potentially short these retracements. We entered in a long trade here, and as you can see, our stop loss was again relatively tight, considering the high volatility that this market was actually exhibiting. And then we managed to get into a contrarian trade and banked 11 axis on this trade following the exact same methodology. Finding the zones, waiting for the price to go under, and then minimizing the risk on this trade as much as we can while maximizing the potential return. With that being said, I hope you guys enjoyed the video. If you did, I would appreciate a sub and a comment below. With that being said, I will see you in the next video. Bye!